Mm, 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 mm. Mm, 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 mm. Hey, you guys, this is Dee Edwards, and I am the ambassador for Alabama, this amazing association. So, thank you guys so much for tuning in, and thank you guys so much for letting someone know that we are live in this amazing community. So, be sure to tag someone. So, the information that I'm about to share with you guys, this may be something that you're already familiar with. So, this is going to come with a refresher, and I want to make sure that we are all on the same accord, especially when it comes to dealing with anything with earned income tax credit. Now, what I'm about to discuss with you guys is about disabled dependents. And the reason why it is important for you to understand about disabled dependents is because, there are tax clients that'll be able to get earned income tax credit because of having a disabled dependent. So thank you guys so much for tagging, wave at me, let me know that you're here. So first of all, it's important to know that when dealing with a disabled dependent, that person can get earned income tax credit regardless of their age based upon the income of the tax client. So if a person was 26 years old, we know that they would not qualify for earned income tax credit. But if they're 26 years old and they are considered disabled, then they will be considered for earned income tax credit. So when it comes to disabled dependents, number one, age does not matter. And number two, in order for them to be considered disabled, this has to be diagnosed by the doctor. So a client can't come into your office and say, hey, this person is disabled because I think that they have a mental illness, or I think that, something is going on with them lifelong. So it's not about think. This is not an opinion. This is a fact, and it's been proven by medical professionals. Okay. And so, two, it has to be diagnosed by a doctor. Now, the doctor has to also be willing to state that the dependent is totally and permanently disabled and not able to work for more than a year, or they are about to die. Okay, that's what's considered disabled. So they're unable to work for more than a year, or they're about to die. So if your client said, hey, this person has been disabled because they've been in a car accident 6 months ago, or they're disabled because they hurt their ankle at work. Yes, they may be disabled, but that is temporary. The key for disabled disability is to be totally and permanently disabled, unable to really function in whatever capacity. So that disability can actually be physical, or it can be mental as well, but it has to be proven by the medical professions. And then it is important for you to understand is that this person cannot engage substantially at work. So it's not they're unable to work due to physical or emotional stance. It's that they're unable to work for physical or emotional, and they cannot basically work substantially. Aubrey, come get the door. Sorry, you guys, cannot work substantially. And so what does that mean? That means that, let's say, I know you guys have seen like somebody who has Down syndromes and they're working at Publix, right? That means that they're not working substantially because Public has to modify some of their rules. Publics have to, treat them differently than they'll treat someone who is considered typical. So when you see someone that's working, let's say they have Down syndrome, they're considered atypical. And so when they're considered atypical and modifications have to be made in order for them to work, that is someone that is is considered unable to work substantially in whatever field. Okay, and it is important as a tax professional, because I know for a fact that when you mark somebody disabled, that is already a trigger. So you want to make sure that you're not just relying upon what your clients are telling you. You want to make sure that you will have them to fill out a due diligence form with these questions on there, or you'll ask them specifically what is the disability. That needs to be in your file. It needs to be on your due diligence forms, and then you need to have something in your records to prove that they are considered disabled. Okay, you need to have either you can have maybe their letter that they're rewarded monthly from payments from being disabled. You can have something from the doctor in there. So you need to have something as proof in your files that this person is considered disabled. Now, as a tax business owner, when my team have someone that is considered disabled, this is something that I have to verify. I have to make sure that they have the right documents in the file, and they're bringing in the correct information to verify that their dependent is considered disabled. And I do this because I know that checking disabled on someone who is older, this is definitely a trigger from the IRS. Now, it's also important for you to know that if your tax client's spouse is considered disabled, they cannot claim their spouse as their dependent. Okay, let's say if they have a parent that is considered disabled. If they have a parent that is considered disabled, that parent is considered considered for other dependent credit, but they do not receive earned income tax credit for a parent. Okay, so that's important for you guys to know. Even if that parent is disabled, even if they're taking care of the family, parent taking providing all of the support, it doesn't matter. Okay, so this is important for you guys to understand. Well, this is Dee Edwards. If you guys have any questions regarding this, hey Joy, if you guys have any questions regarding disabled dependents, be sure to put it in a comment, and I'll come back at a later time to address it. Thanks for tuning in, and have a fantastic day. Toodles for now.